All right, good evening, everybody. We'll go ahead and get started. My name is Nikki Whitaker. I'm the membership coordinator at the Kentucky Cattlemen's Association. And tonight we are doing a two-topic look at price discovery and just giving an overview of that, and a look back at 2020 markets and an outlook for the 2021. We have with us Dr. Kenny Burdine, who's at the University of Kentucky. Everyone, I think, should be familiar with Kenny here. He's made his rounds to County Cattlemen's Association meetings and been at our convention. He's a good friend of the Cattlemen's Association. The other thing that I want to point out is if you haven't signed up yet for the Cattle Market Notes Weekly, Kenny is a part of that with Mississippi State, Josh Maples, and the University of Arkansas, James Mitchell. So be sure to sign up for that. It's a great overview of the cattle markets and just the economy surrounding the cattle industry. I also want to point out, if you haven't already signed up here, let's see if I can advance my slide. There will be a cow-calf profitability conference. That is, help me, Kenny, March 23rd, 24th, and 25th, if that's correct. Yep. And so both tonight and that cow-calf profitability conference is supported by the Kentucky Beef Network, and that's funding through the Ag Development Funds. So we'll get started with our topic tonight. Kenny, I'll turn it over to you. Let me stop sharing my screen. Okay, and you have it.
Well, thanks a bunch, Nikki, and certainly thanks to Becky. And I don't know who all else is on from KCA, but I definitely appreciate the invite and a chance to do this. I've been looking forward to it. So I'll definitely be glad to when I'm back on the road doing more of those cattlemen's meetings in face to face. I can tell you that for sure. But good to be with you virtually tonight. So there's three goals for what I want to try and do in the next, 45 minutes to an hour. I want to talk about price discovery first and just kind of really differentiate between price discovery and price determination, and just talk about what we can expect from price discovery and what we can't. That's kind of the goal of that first piece. I'll kind of quickly review some things from 2020 and what COVID did to the cattle markets. And I really want to focus towards the end about just kind of my expectations for 2021. I think there's reason for optimism, and I definitely want to walk through some of that with you. The first thing I really want to do is just break up the difference between these two terms, and they've been tossed around a lot. It's been a hot topic back since probably June or so of 2020. But the price discovery term gets used almost interchangeably with price determination, and they really are two separate things. Price determination really refers to the broader interaction of supply and demand, general market factors. And the way that I like to describe that is price determination issues are things that impact all cattle that are sold, market shocks, so forth. Price discovery has more to do with how the individual price for an individual group of cattle is arrived at. And I like to say that oftentimes comes down to selling method, and it comes down to differentiate those differences. So, for example, I was just talking with both Nikki and Becky. If the three of us all sell an identical group of cattle on the exact same day, we're selling them in the exact same market conditions. If I sell mine through the stockyards, if Nikki sells hers through an internet sale, and if Becky sells hers, direct to a feed yard in Nebraska, for example, but they're the exact same type of cattle on the exact same day, then the difference in what they bring is price discovery. If something changes in the market between when I sell and when Becky or Nikki sells, that change is a price determination factor. And I think kind of separating those two that way sometimes often helps. So major market shocks that we've seen over the last couple of years, and I mentioned both the Halcombe fire and COVID-19 because they both had elements of a processing bottleneck, certainly. COVID had some demand implications as well. But I like to kind of point out that those are things that impacted the value of all cattle in the system, not just certain groups of cattle. So those were price determination issues, not price discovery issues. And that's another way to kind of separate and differentiate those two terms. Now, what can better price discovery do? It can do some very important things, and it does. It can provide cattle values that reflect supply and demand conditions. That's ultimately what I think the goal is of any market, is you want values to reflect, the actual value of the cattle. Good price determination, good price discovery can lower volatility. And that's a good thing in the marketplace. And then the third piece is really where I want to go in the next few minutes, is good price discovery can provide a basis from which we can value other groups of cattle. And that's where this formula pricing discussion comes up. And really, formula pricing has been what a lot of the price discovery discussion is centered around over the last several months. We also need to understand, though, what price discovery can't do. And it can't prevent major shocks from impacting markets, something like the Halcombe fire, something like COVID-19. If you go back to 2003 and shortly after that, BSE shocks, trade shocks. Price discovery can't prevent those things from impacting the market. They can improve margins across industries, across the entire beef sector, and they can't guarantee higher prices. And, a lot of economists have said this, and I'm going to say it now, and I'll say it towards the end. Just because we've got better price discovery doesn't necessarily mean that we've got higher prices. You can have one and not have the other. Now, in terms of actually kind of trying to define it a little bit better, I want to distinguish between negotiated trade and formula trade. And of course, most of this applies to, the interactions between feedlots and packers, but the same thing would apply in Kentucky when feeder cattle are sold. Negotiated sales are prices for cattle where the price is determined right then and there. There's a bid, there's an ask. You'll oftentimes hear me use the term spot market. And that kind of is an easy way to think about it. It means the price for those cattle was determined right then. Snap your finger. Now, in reality, it's kind of defined within some window, typically, not necessarily that they had to be delivered the same exact day, but within some window. If I had bought a group of cattle back in January, but received delivery of them today, well, whatever I got for them today was more reflective of January conditions, not today's conditions. So that would not be a negotiated trade. When you think negotiated, just think about spot market. But the nice thing about negotiated trade is that it should be very representative of the current market conditions. And that's why it's important. That's the best information we can get about the value of cattle comes from negotiated trade. It's negotiated right then and there. And this is also not deniable. The more negotiated trade that we have, the better price discovery in the market. So now we've kind of come back full circle and kind of brought this back to price discovery. Now, we've moved away from negotiated trade in a lot of ways. There's a whole lot less negotiated trade now than there was, 5 and certainly 10 or 15 years ago. But I do want to make just a very quick, simple illustration here to make a point. I'm going to ask you which of these two is the most efficient way to purchase or sell a group of cattle. So use your imagination. This is not feedlot country here in Kentucky, obviously. These are some cattle that we were sorting to sell, I think, 8 or 9 fats out of. So there's cattle here of all sizes. We were simply going to sort off the top, 8 or 9 to sell back in the fall. So pretend that these aren't standing in pasture, pretend that they're all the same, they're all finished cattle, and pretend that we're not sorting by polytape, all right? But if I were a buyer for a packing plant and I were walking through a feedlot looking at a group of cattle like what you see here, I'm going in and I'm visually trying to assess what those cattle look like when they're standing there on the hoof. So I'm using my eyes as best as I can to gauge how much finish I think they have. I'll probably get a weight, but I'm trying to gauge, what percent do I think are going to be choice, or are some of them going to be a little bit too fat, grade 4s and 5s. So I'm trying to assess that visually. And then this is a picture from obviously a large scale packing plant. And I'm using this to illustrate what grid pricing might look like. All right. And this has been going on for a long time, right? Grid pricing is not new by any stretch of the imagination. It's been going on for decades now. But it's hard to argue that, by weighting and valuing those cattle based on actually what their quality is on the rail, it's hard to argue that grid pricing was not an improvement in the marketing of cattle. It was more efficient. Another way to think about it is, if I'm looking at cattle on the hoof, it's absolutely easier to slip some poor quality cattle through. than it is if I'm looking at them on the rail. And I just illustrate this to say that, some of the movement away from negotiated trade is because of value-based marketing like grid pricing. And most of us would agree that there have been some real gains because of grid pricing. It's made us, I think, a better industry overall. Now, I tell my class, my livestock marketing class at UK, I want to simplify the world sometimes to teach concepts. And that's kind of what we're going to do here to begin with. So I'm going to just simplify the world. I've got a processor here in the middle, and then I've got feed yards that processor is going to buy cattle from. And each one of these dotted lines is going to represent a negotiation or a negotiated trade for a group of cattle. So if I'm the processor, I go to feed yard 1 and I send a buyer, I look at those cattle, I assess them. The feed yard has an ask, I've got a bid, we arrive at a price, we negotiate, there's a sale. I go to 2, again, bid, ask, negotiate, sale. I go to 3, bid, ask, negotiate, sale. And we can keep going, okay? The point is I can go around to every single one of these feedlots and don't think about them as 16 feedlots. Think about them as all the feedlots that I would buy from, okay? And I can negotiate a price for every single group of cattle that I buy. This is a market with 100% negotiated trade. And frankly, very good price discovery, because every single trade was negotiated and the price determined right then and there. Now, on the other end, we've got obviously a lot of these non-negotiated trades or non-negotiated transactions. And we're never short of acronyms in agriculture, certainly not in the beef business either. But one that you want to know is alternative marketing arrangements, AMAs, has been tossed around a lot. And you want to think about those non-negotiated purchases. So captive supplies get a lot of attention. That's packer-owned cattle. Some of that absolutely goes on. Forward contracts are generally defined as cattle purchased more than 30 days ahead of time. There's obviously some of that goes on. But the one that's got the most attention, going back to about summer, has been the formula trades. And these are transactions where the price was based on some other market or some other indicator. So it might be a price based on the plant average. It might be a price based on some sort of regional price index, the 5 market average, the Iowa, Minnesota average. It might be based on futures price. But the bottom line is we didn't arrive at a negotiated price. We based our price on something else. So we could negotiate the terms, but the formula was set ahead of time. And that's where a lot of our volume has gone over the last several years, much more so than negotiated. So again, simple illustration. Here's my simple world where everything is negotiated. Okay, so again, I'm laying this out very simply, so excuse me for the simplicity of it. But let's say after I negotiate with the first 15 feed yards, I get to feedlot 16, and I say, you know what, we know what this market is. We do. You've got good cattle. You always do. What if I offer you $1 above this weekly average? And feedlot 16 says, well, that sounds reasonable to me. No problem. We basically arrive at a formula price. And we've based the price for feedlot 16 on the price of the other 15 feed yards. And again, don't think about them as 15 and 1. Just think about them as that share of the market. Okay, so here I've just based a very small share of my purchases on a very large share of negotiated trades. The next week I do the same thing with feedlot 15. So now I'm negotiating 14/16 of my purchases, and I'm using that for formulas on 2/16. And then here's a world where 75% of my purchases or 75% of my transactions are negotiated and 25% are formula. Here's half and half. Here's 25% negotiated, 75% formula. And then we can be in the other extreme where I've got a very small number of negotiated trades that I'm using to base a very large number of formulas on. And a lot of this discussion about price discovery and negotiated versus formula really comes down to how much negotiated trade, how many dotted lines do I need to have a good enough market that I can base these formulas on. That's what a lot of the discussion really comes down to. And we'll visit that again in just a little bit. But that's the idea of negotiated versus formula. Understand there are legitimate reasons why formulas are attractive. And they're attractive, frankly, to both parties in some ways. And one is just there's a lot less transaction cost. Think about from the packer perspective, the buyers that go out and look at cattle, and they do this negotiation with somebody at the feed yard. There's less need for those folks in a formula type environment. And for that matter, the feed yard doesn't have somebody who's responsible for marketing those cattle, at least not to quite the same extent. And oftentimes, some of the higher paid folks in those feed yard businesses are the folks that are the ones negotiating with those packers, right? So there is some savings associated with that. And Stephen Kuntz at Colorado State, Stephen does what I do for Colorado. He's in a similar role to mine. He's been there a lot longer. Very well respected. But he estimates the value of formula transactions at about $25 a head. So based on these savings, these benefits, there is some advantage to having the ability to do this. Now, this is data, just to put in perspective for you. I could have shown you a ton of graphs, and I'm not going to go real heavy on those. But the red line here is formula transactions. The blue line here is negotiated transactions. And this just goes back about 5 years, but I could go back even further. And what you would see is that blue line would be trending downward. So negotiated trade lately has been between 20 and 25% of sales or transactions. And then formula has been doing the opposite. It's been running lately more kind of in the 65 to 70% range. So you cannot deny the fact that we are moving more towards formula and away from negotiated trade over time. It is absolutely happening. You also can't deny the fact, though, that the formula approach is efficient, probably from both a buyer and seller's perspective. And I do think sometimes we forget that both the buyer and seller are involved in this, right? There's a reason why packers, like the formula approach, and there's also a reason why feedlots agree to that. So both have a benefit, or they wouldn't be agreeing to them. There's also no doubt, though, that we need some level of negotiated trade to have a good, robust market, meaning good price discovery. And what that tends to be is somewhat debatable and does vary across region. And Kuntz, that I mentioned earlier, has done some work on that, and it varies somewhat by region, but that's kind of where a lot of this discussion really centers from. So I guess what I would want you to know before I leave this topic and talk about the market is, first of all, we've got to separate price discovery issues from everything else. Don't confuse price discovery issues with market factors like COVID and the Halcombe fire and major demand shocks. They just really are two different things. Don't just assume that because this discovery topic became a hot topic last year means it would have changed a great deal about what our market did when we saw production drop by 35 to 40% there for a couple of weeks. That was a market range factor that was definitely there. Negotiated trade's been declining. And at the same time, understand there are good reasons for that. And I used my value-based marketing, my grid pricing as an illustration of that. But just basic efficiency, there are reasons why formulas make sense. And I'm, just understand that they're attractive to buyers and sellers for a few reasons. There's also very good reason to want more cash trade. And as an economist, I want robust markets that provide good price discovery. So, we do want to keep an eye on this and make sure we do get enough negotiated trade to actually have good, robust price discovery. As an economist, though, what I do have to point out, and I think why a lot of economists would, and why many would say the exact same thing I'm about to say to you, is that anytime you force something like more cash trade onto a market, you're imposing more cost on the system, right? You are imposing more transactional cost. Negotiation has a cost. Having buyers and marketers out there has a cost. There's been some literature, there's been some work done on failure risk and how, the number of people that I could potentially buy or sell from increases the concern I've got if I can't get a trade done. So there's some cost there. Not to mention we've got compliance, right? If I've got a certain amount of cattle that I've got to purchase a certain way, I've got to have someone assigned to do the paperwork and the compliance piece of that, right? And when you think about those costs and potentially the benefits we wouldn't have from formula pricing, it's hard to argue that those costs, if they increase, don't get passed back to the feedlot. I'm sorry, to the feeder level and the cow-calf level, right? We all know that as corn price goes up, feeder cattle price tends to come down because that cost ultimately gets passed back. And any cost like this could potentially get passed back to the cow-calf and feeder cattle level. So that's one concern that a lot of economists have about doing something like this. And again, just remember that there's a difference between price discovery and price determination. And just because we've got more price discovery, just because we have more negotiated trade, does not necessarily mean we're going to have higher prices. We could have better price discovery and actually see lower prices. That is a possibility. So make sure you understand the difference in the two things. Now, as we shift and start thinking about the 2020 market and then ultimately going to the 2021 market here in about 10 minutes. But if we think about COVID and what it did to the market, I kind of describe it, first of all, as a two-pronged demand shock. Dominoes just started to fall. In February, we were talking about trade implications, right? I mean, we didn't really have much in the United States. Didn't have much COVID in the US. And then as we start to see cancellations and shutdowns and layoffs, I think there was an initial negative demand shock, right? And then we start thinking about stimulus money. We start thinking about enhanced unemployment. We put some buying power in the hands of consumers. I think there was actually maybe a positive demand shock there in kind of phase 2 of that. And then shortly thereafter, we see our spring processing bottleneck. And this was kind of at its worst the first week of May, but I'll show you that chart in a second. But it created this backlog of cattle. And that was probably the biggest market impact for those of us that are on this call now in the cattle business, is that backlog of cattle that we didn't have near enough capacity, and we didn't have near enough ability to process the cattle that were on feed. And of course, that sent shock waves all the way back through the system. The restaurant struggles were big. The food service sector is very important to all meats. I think it may actually be a little bit more important to beef than many others because a lot of our upper end higher value cuts do move through restaurants. And obviously a whole lot of burger does as well through your fast food type restaurants. We saw retail and consumer shifts. There was a lot of really fascinating stuff when you kind of look back and think about that transition period between March and May, when we literally had to divert so much product that was destined towards food service and had to be shifted to retail. It was happening so fast, and we were also frustrated. Didn't really think about what was going on, but that was just fascinating what we saw. But maybe more than anything else, markets do not like uncertainty. And in a year like 2020, you were constantly adjusting to what was going on. There was just, things were never the same for a week or two at a time. Markets don't like that, and they respond to uncertainty and adjustment via typically price discounts. And that's largely what we saw. I won't spend a lot of time talking about this. I've done enough of these type of things over the last year that most everybody's kind of seen these basic charts. But here's the first week of May. Beef production was down about 37% from where it was the same week in the year before. So this is May of 2020. Dotted line here is May of 2019. Notice though that even we were actually moving quite a few cattle through the system pre-COVID. I was asked to do a webinar back in June for Seafair about the resiliency of the U.S. beef system. And one of the things that I pointed out was I'm convinced that our system saw what was probably coming and was really trying to move a lot of cattle through the system. And I could also show you beef in cold storage that would kind of move up in the wintertime when it usually gets drawn down. We were doing what we could to get ahead of it. But folks, this was a major blow. There's just no other way to say that. You're not going to have this type of decrease in production and not see implications back on the cattle side and then forward on the meat supply side. But then by the time we get into the summertime period, we were running production actually a little bit above last year. And it's telling to me that actually beef production was more or less flat in 2020, despite what we had here for 4 to 6 weeks, kind of the worst of this. But because we were moving pretty swiftly ahead of time, and even after the adjustments, we're doing a pretty darn good job, from summer on. We actually saw beef production roughly flat from 2019 to 2020. Don't want to talk a lot about weights, but this is the other piece of the backlog. When you've got fewer places to go with cattle and they're on feed longer, they get heavier. Dotted line here is 2020. I just want you to notice what was going on. This is about the end of April. So here's kind of middle of June, maybe 1st of June. Okay. Notice our weights were going up in 2019 when ordinarily they go down. That's just classic backlog. And weights are absolutely one of those things we forget about sometimes, have a big impact on beef production. We've had a lot of big cattle the last few years. One positive of higher grain price, and I don't want higher grain price, don't misunderstand me, but one positive is we are seeing those weights come down some. You saw it towards the end of 2020, and we're seeing them pull down more than seasonally normal so far in 2021. So going back and kind of walking sector by sector here through what happened in 2020. If any of you retain ownership on cattle, had cattle on feed out in the Midwest, they were hit the hardest on a per head basis, right? The closer we are to the knife, the bigger the impact typically is of something like this. So, cattle on feed, probably value dropped $225 to $300 or more, big impacts on a per head basis. Winter backgrounders who had bought cattle in fall of 2019 with plans to sell, heavy feeders in spring of 2020, they were hit very hard too. My best guess was maybe $175 to $150 or so of value there, depending on when you sold, that was lost. Of course, a lot of these folks were hit pretty hard too. The first round of CFAP had 2 payments. The first was the CARES portion, right, which was based on actual sales. The second smaller payment was based on inventory. But the sales window was January 15 to April 15. And that created some heartburn with some folks, understandably so. January 15 was early, in my opinion, for a lot of that. And then a lot of these folks kept cattle past April 15. A lot of them normally would anyway, and many more were basically hoping for some improvement in the marketplace. So that April 15 created some heartburn for sure. It also impacted fall calvers. If I'm a fall calver that calves in the fall and sells calves in the spring, we tend to keep calves on the cow a little bit longer in the spring of the year as grass starts to grow. So, a lot of those folks sold past the April 15 window. But even beyond that, we didn't get a price peak. I'm convinced that our spring market in 2020 was probably 20 cents or more lower per pound on calves than it would have been had it not been for COVID. So, you're talking on these calves that were, 400 to 600 pounds in the spring of the year, you're talking $100, $150 a head probably of lost value, something in that ballpark. And even our spring calvers that didn't sell until probably fourth quarter of 2020, there's no doubt in my mind there were lingering effects there. Not as much as the spring market, but I am convinced that, that we would have had at least 5 or 10 cents higher prices last fall had it not been for COVID that we dealt with in 2020. So again, you're talking 25, 50 bucks a head here, calves that were sold. And folks, that is not an insignificant amount of money at all. So I guess the point that I'm making here is it impacted the market from top to bottom. No matter where you were impacted. The lone bright spot was cull cows and slaughter bulls. They were strong for the bulk of 2020. A couple of reasons. Number one, we stayed a lot more current in the processing. We didn't get near the processing backlog in the mature slaughter markets that we did, the steer and heifer markets. And frankly, we were just in a very at-home meat consumption market, which in at-home consumption tends to lend itself very well to ground beef. Think about burgers, tacos, burgers, tacos, chili, spaghetti, things like that are more common at-home consumed products. So that was the lone bright spot. I'm going to talk very quickly about this, but it's interesting to look at production in 2020 and what the expectation is from ERS in 2021. Again, our cow numbers peaked in 2019. So that should have meant that our beef production peaked in 2020. right? But we pushed some of that production in 2020 into 2021 due to that backlog back in the spring, right? We're still kind of dealing with some effects of that. So we're going to see more or less flat beef production from 20 to 21. We're going to see an increase in pork production, but much less than we would have seen had it not been for COVID. Think about African swine fever in China and what it looked like was going to, what 2020 looked like pre-COVID. Should have been an outstanding year for the hog industry. So they were poised, I think, to see some real expansion. They're going to see very little now. And this broiler change is not insignificant at all. You typically see broiler production increase between 2 and 3% a year, but they can respond very quickly to supply, or their supply can respond much quicker than beef or pork. I always like to say that I can pretty much track broiler production in weeks, pork production in months, and beef production in years, and there's a lot of truth to that. So the fact that we're going to see less than a 1% increase in broiler production in 2021 to me is telling. And I think the real story is here, and I'm going to show you an export chart here in just a minute, but although we're going to see some small production increases in 2021, I'm optimistic enough about exports to think that actually per capita availability in the United States will actually be lower in 2021, which is, I think, going to bode well for these markets in the current year. The last few weeks have been a little bit frustrating, and we can blame weather on some of this, of course. We're not quite to the spring grilling season yet, but it's been a little discouraging. I almost want to say a little bit worrisome that we've not really been pushing slaughter steer prices much higher. Same thing, boxed beef pulled back a little bit last week. That's not typical. That does worry me a little bit, but watching that closely, of course. I want to talk Kentucky feeder and now calf prices. So here's, I usually track an 850-pound steer and 550-pound steer comes my baseline for the state. Obviously, the blue line here is 2020. You can see that drop from January to April, about 25 bucks a hundredweight last year. I want you to notice, though, I've got 1 week of prices for March, and I don't like to include 1 week worth of price data for a monthly chart. It just can be a little bit deceiving. But this is deceiving in a couple of ways. Now, again, black line is what I kind of call a long run, like a 10-year average. Okay, this is 2010 to 2020. So ordinarily, we see these heavy feeder cattle prices decrease January, February, and March, and then start moving up towards summer. Okay. Now, this looks like, and actually was, a pretty sharp drop from January to February in the current year. However, I want to remind you that 2 of those weeks in February were really difficult weeks to move cattle. We didn't sell as many, some yards were closed, transportation problems were there. Feed yards were not as excited about placing cattle. So I think this almost understates the February price. That last week of February, so now that would have been roughly 2 to 3 weeks ago, looked a lot better than the second and third week. So I just kind of make that point that I'm always going to show you what the data says. I'm going to kind of explain if I think it's a little bit off. But if you look at the first week of March and the last week of February, this market looks a whole lot better than it did, back in mid-February. So I just make that point. Similar story here on calves. This looks like a very small increase in calf price between January and February, and it was. But again, last week of February, prices were higher. And if you look at the first week of March, and I actually pulled up my first part of the week sales here before I talked to you today, there is no question this calf market is improving. It's literally week by week right now. And that's been encouraging. So I like these monthly charts because you don't get kind of the volatility from week to week, but they also can do strange things when you've got 2 weeks out of a 4-week month where the market was very deflated due to weather. Here's my cull cow price chart. Again, that black line is kind of my longer run average. Remember, when you see a 10-year cull cow price chart, or anything for that matter, the prices are almost artificially high there because we had such strong prices in 14 and 15. I think we all would agree that 2020 was a pretty good cull cow year, and slaughter bull year for that matter. And just notice what this cow market has done the first 2 months of 2021. We're still in a pretty good market, I think, for cull cows, for bulls, and for birder. Our calf market tends to peak usually early to mid-April. Our cull cow market's usually a bit later, usually think something like May or June. So that's kind of when our peak usually occurs seasonally. So a lot of things look a whole lot better, certainly, than they did even a few weeks ago. As we start thinking about the rest of the year, here's some things that are in the back of my mind, having the back of yours. I'm not making a political statement at all. I'm just simply saying that it's really hard. I'm not a macroeconomist, but it's really hard to put your finger on this economy right now, right? We passed two very sizable stimulus packages in 2020, and a third one's probably going to pass here in just a matter of days, right, and be signed into law. There's absolutely no question that has had an impact on the economy. It certainly did last year, certainly is now, and the anticipation of that is affecting 2021. So it's almost difficult to sort out where we are in the COVID recovery because of that, right? How much of that is due to the stimulus versus how much is truly things improving. The food service sector has just been fascinating to watch. And I chose not to get into this detail tonight, but it's interesting to look at wholesale prices in different cuts and retail prices in different cuts. And you can almost see the ones that were very food service oriented and how they responded back in the initial stages of the pandemic. And to me, you've almost got to separate the fast food market from the sit down type restaurant market. Fast food quickly, and I don't like to use a lot of anecdotal stuff when I talk to a group like this, but folks, have you ever seen drive-throughs backed up like you are right now? So I live in Nicholasdale. I drive from Nicholasville to Lexington a lot. My wife and I were down in Birmingham Thursday through Saturday at the Alabama Cattlemen's Association. So I had a chance to kind of see, a fairly sizable city there in Alabama, and it's just amazing how much volume we're pushing through these fast food places. And a lot of them are not opening up their inside. So I think given the capacity reductions, they decided, well, we're just going to kind of focus on, rolling through the drive-through and being efficient at that. It's kind of that Rally Sonic model that has been around for a while. So that's been interesting to me. Our sit-down restaurants were obviously hit extremely hard in spring and summer. A lot of them opened back up at limited capacity. And a lot of them, were using outdoor seating to try and expand capacity some. And of course, that window got closed shut this winter. So we're moving back into a time when we can do more of that. But, the other question is, how much of a habit has consumers, or I said, how people are creatures of habit, right? And a lot of people are a lot less accustomed to going out eating than they used to. I have no doubt that the sit-down type restaurants are going to regain, but it may take some time. I think it's going to be well into 2021 when we start to see a lot of change there. Feed costs continue to be an issue, and I'm going to show you a little bit about weather here in just a second. So I've just chosen Oklahoma corn price here as just an indicator. But if you go back and look really about mid to late August, where corn price was and where it is now, I really have to think really long and hard about the last time we saw this much run up in grain price from August until spring of the year. Sometimes you see it within season due to drought, right? Think like 2012. But from, by the time we're in August, we should have a pretty good feel for how big corn crop is. And, that was probably now granted the corn crop smaller than we thought it was at the time. In major export movement, and this was a heck of a run up in grain price. And I really think had it not been for the pandemic, we'd be talking a whole lot more about the impact of these feed prices on the cattle markets than we have been. And then I've also been watching this. About the western half of the U.S. is in some form of drought. If you look at where the bulk of the cattle are, I would say there's three main areas. You've got certainly the southern plains here, think Texas, Oklahoma, what have you. You got the northern plains and you got the southeast. And, those two biggest areas are dealing with drought and really have been for the most part since last fall. So this is certainly something to watch as we start moving into spring and summer. If this continues, this is probably a market changer. The cow herd is getting smaller. 2020 was our second year of reductions in the size of the U.S. cow herd. which is what this market needed. The 2021 calf crop will be smaller than 2020 calf crop, which is a good thing for us that sell cattle. A lot of folks, including myself, were surprised that beef cow numbers weren't down. More than they actually were. USDA had the 2021 beef cow estimate down 0.6%. I'd estimated to be down between 1 and 1.5%. It doesn't sound like a lot, but that's a lot of cows. That was a bit of a surprise. The real story, if you read Cattle Market Notes, we wrote an article about this, I think 3 weeks ago, maybe. The real story in the inventory report was more about the revisions of the 2019 and 2020 numbers. So they reduced the calf crop in both of those years. I wouldn't be surprised at all if this cow herd right now doesn't get revised downward a bit more when they look at it again next year. That'd be my guess. In addition to a smaller cow herd, though, the other positive factor from my perspective is that exports have really improved. Exports were down for 2020, but understand that's mostly because of what we saw in the spring and early summer, right? When production was down in the United States, naturally we were not exporting as much, and that made perfect sense. So exports were down for the year, but look at what we saw in the fourth quarter. Here's September, here's December, about where we started last year, which again is well above that longer run average. I want to show you one more here that I found very interesting. This was in the last week's Cattle Market Notes. When you look at the difference between, and this is just one month, okay? But if you look at the difference in beef exports to China from January of 2020 versus January 2021, an increase of over 700%. Now, this is still a small share of our beef production. Don't misunderstand what I'm telling you, but I thought this was very interesting. And look at this growth, which is really what it's telling. Look at this growth from early 2020 to the end of 2020 and start of 2021. This is very encouraging to me. So I view exports very much as a positive looking ahead for 2021. All right, my last 2 cents worth on these markets and what I think we're going to see for the rest of 2021. I always like to joke and say that, you know, there's a lot of uncertainty here and whatnot. You know, I'm giving you my best guess on some things. You know, I can be wrong, but my philosophy is you want my opinions, so here it is. In a lot of ways, I think the 2021 market should be the 2021 we expected had it not been for COVID. Calf crop smaller, demand should improve throughout the year domestically, especially the restaurant side, and I'm optimistic about exports in 2021. So I think we'll see the best spring calf market we've seen since 2016. Anytime I'm doing forecasting in the spring of the year, it's difficult because the market is literally moving week to week. So I kind of watch state average prices, and that's kind of what I base a lot of my forecast on. But the problem with averages are they're too high for half of you, too low for the other half. And that's just how it works, okay? So I like to talk more in terms of change. Last week, a 550-pound steer moved kind of in the 145 to 150 range on a state average basis. Okay, I think that same steer will be in the 160s come about the second week or so of April. So I'm expecting him to be about 15-20 cents higher than he was last week. And I think when the numbers come out on Monday, he will have already started that pretty well. Your Monday and Tuesday sales look like we'd already increased some. So this calf market is starting to run. I do think we'll see a seasonal drop in calf prices. I think they will decrease especially from summer into fall, but I think we'll see a stronger fall market as well. I'm thinking that the calf prices that we move in fall of 2021 will probably be about 10 cents higher than they were in fall of 2020. So that's about $50 or so ahead. So that's not a great calf market by any means, but it's certainly a lot better than we saw last year. So I definitely look for a better year on the cow-calf side. One of the reasons why I'm encouraged about this calf market this spring has to do with where our fall feeder cattle futures contracts are. Now, spring has been stubborn, and I can't fully understand why we're not building more momentum on these heavy feeder cattle this spring. But I've got these fall contracts, which is your heavy feeder cattle market for fall. I've got them on the board in the mid 150s. I can take that futures price back into a Kentucky price and then think about what I can pay for a 5-weight steer, and it's a pretty darn good price. So as these stock operators compete for these calves, given that fall market expectation, we're going to bid these calves up. If you're a stocker operator, you're going to be placing into a market that's running. And I always say price into it, don't chase it. It's been a long time since we've seen a market with this much carry. And by carry, what I mean is this notion that literally month after month, we expect better prices on the board. So it's been a while since we've seen this kind of magnitude. This usually bodes well for stocker operators. The other thing that I'll say, again, I don't like high feed prices, but one thing that happens with high feed prices is we tend to see good returns to stocker programs. For one thing, feed yards aren't as aggressively bidding on calves to place. So oftentimes the stock operators can get those calves bought a little bit cheaper than they would otherwise. The other thing though is, when feed prices are high, we tend to see price slides narrow. And by that, I mean, the discount for price based on weight, meaning what 6 weights, 7 weights, 8 weights, so forth, tends to narrow, which what that really does is that means the value of the pounds that I add are worth more. So if I'm a grazing operation, my costs don't change that much, but because the higher feed prices, my value of gain increases. So stock operators usually actually make more money in an environment where feed prices are high. Last thing I want to talk about, and we'll stop and take questions. Everybody's aware of this. I hated not to mention it though. We were already a bit strapped for local processing capacity, pre-COVID, and we all know what happened last year. We had booked up almost all of 2020 by probably, I don't know, certainly the middle of May. I'm talking to you in March. We do some freezer beef ourselves, small scale. If you're trying to get a date right now, you're probably looking 2022. So that has been a challenge to meet some of this demand. But on the same note, it's also encouraging to me that a lot of that demand that we didn't know how long it would last in spring of 2020 has seemed to stick around for 2021. So that's somewhat encouraging. I do think there's potential for more local capacity or more local process capacity in the next 1 to 2 years. Nikki mentioned this and I appreciate it. If you're interested in getting cattle market notes, this comes out every Monday afternoon. I write this on a rotating basis with Josh Maples, Mississippi State, and James Mitchell, University of Arkansas. Nicole, my extension staff person, put this together. This is a QR code. I have a cheap old smartphone that won't do this, but if you've got a smartphone, you can use your camera feature, and this will take you right to the website to sign up. If you can't do that, you simply email me and I will give you the website to sign up. But I'd love for you to get this every Monday afternoon. It's a good newsletter, and because the three of us are in the Southeast, it tends to be a bit more feeder and cow-calf oriented than some of the other stuff that comes around. So would love to see you do that. By the way, Josh and I on April 20th are going to do a program focused on risk management. We're going to really focus on livestock risk protection insurance. So that's an insurance product that's a whole lot more attractive now than it was several years ago because of an increased subsidy level on the premium. So talk about that as part of the Reaching Out While Locked In series that the UK Beef Group is doing, and that's going to be on April 20th. So look for notices about that. I hope that you'll jump on. So again, I certainly want to thank KCA for the invite and the chance to do this. This is my contact info. You're welcome to reach out to me anytime. I'm always glad to hear from you. Email, phone number, and follow me on Twitter at KYKettleEcon. I'm going to stop sharing and I will see if we've got any questions or anything to discuss. Thanks again, everybody.
All right, thank you, Kenny, so much. I'm always impressed with your ability to help me understand economics. It definitely wasn't a class I did well in, but I feel like you put it in perspective for, I know for myself and our members, because I hear the compliments of it all the time on how well you can explain things. So definitely that's what I wanted out of tonight's presentation, was a good, thorough explanation. And again, just kudos to you for doing that. We're going to throw some questions at you. I do want to point out that for many that are on here, you may have gotten our membership survey. That's kind of what prompted this discussion tonight, because a lot of people wanted more information on cattle markets and just economics in general. I've got some of those questions from here, but our chat box is open. There's also the Q&A box. Becky and I will monitor those. But I guess the first one, Kenny, you had mentioned this. You talked about cattle numbers in our inventory here. I know that we kind of announced a decrease even in Kentucky of the decrease in the numbers. Do you see that as a trend? I mean, I know trending down would equal better prices, as we saw in the 15 and 14 years. But what do you, I mean, just your opinion, what do you see as a trend?
No question. The two things that drive cow numbers, I always watch cow numbers more than anything else, because cow numbers equal your calf numbers, right? So I watch cow numbers and calf crop. The first, though, is calf prices. And that's been our problem the last few years, or one of our problems, right? So I think we're seeing cow numbers decrease partly because of that. And the second thing is weather. And sometimes weather can even trump price. But, you start watching these weather patterns in parts of the country and start thinking, okay, if that continues, we're going to be moving some cows. And, it was low beef cow numbers in 14 and 15, honestly precipitated by some major drought in the Southern Plains, 2011 to 2013, that left us where we were in 2014, 15. So I do think this cow herd is decreasing. I think it will do so for a few years. If I had to guess, I think this cow herd will be smaller again next year and probably the year after that. That's my best guess. And that's holding weather constant. You mentioned Kentucky. I was very surprised in 2020 that they didn't have our beef cow numbers lower. They had us, I think, basically flatter up a little bit. They had us down 4% this year, and I think that made a lot more sense. Based on what I see and just from the numbers going through yards and talking to producers and agents, I think our cow herd has gotten smaller in Kentucky over the last couple of years.
Rookie mistake, I was muted. So switching gears, none of our questions really follow the same pattern, so we're going to be switching gears for every one of them. There was a question in the chat box, so if I don't ask, oh, you got it? If I don't ask this correctly, I'm going to give it to Becky, but if we don't ask it correctly, just please rephrase it.
So Kenny, it's a question about, does the beef quality assurance program have an effect on prices? And for the producer that asked this question, I did also reply in the chat box that you can enroll for beef quality assurance in Kentucky. We have an online enrollment option, or you can contact your local county extension office. There is also a national BQA program that you can enroll in as well, if you feel more comfortable doing that. And that I will put that website in the chat box as well.
Yeah.
Go ahead, Kenny.
Thanks so much. So the question is really about BQA and does it add value to cattle?
Yep.
I think the answer is yes. One of the difficulties with that is it's hard to separate BQA from other things that go on, right? Think about what BQA is, think about what you learn in BQA, and don't take BQA lightly. When you are BQA certified, you're basically saying, I have gone through training and I'm going to manage my cattle this way to add value. So that's why we couple BQA with preconditioned sales like CBH 45, right? And there's no question that those preconditioned sales, we've got uniform health programs and we've got BQA certification, that adds value. It's hard to separate those three things, right? What's the grouping, what's the preconditioning, what's the BQA value? But no, there is no doubt that BQA adds value. And, in some ways it's almost becoming the norm, right? That's almost the expectation now. And it's almost more like there's a discount if I'm not. And that oftentimes is what happens, right? When we do a better job as an industry, that becomes the expectation. And it's more a function of, okay, what's the discount if I don't do that? And that's kind of where I think we're moving with BQA, honestly.
All right, this next one, are there any alternative opportunities to increase returns on beef?
Okay, so the question is about just in general ways to increase returns.
Yeah, just different. I believe this is more of a marketing question,
Gotcha.
definitely. Yes, but just alternative opportunities to increase that return.
Yeah, let me answer it a few different ways. So one of the first things that I always say, and I don't know, I'm assuming it's a cow-calf producer probably asked the question, but the first thing I always say is, okay, let's make sure we're doing the little things, right? And little's not oftentimes the right word, right? But let's not sell cattle that somebody else can buy and upgrade them very easily. Let's do the things like, let's sell high quality, let's sell preconditioned cattle, let's sell steers, not bulls, right? Let's try to have a calving season that allows us to sell in larger lot sizes. Let's do those things first. And then beyond that, I think you're looking at other alternatives, right? And some of this depends on size, right? But there are people, good cattle producers, right, whose business is focused on, buying weaned calves and growing them into, marketable feeder cattle, right? But I always say, if you're a cow-calf operator, you can play that game as well. In fact, you have a bit of an advantage, right? Because those are your cattle. You know how they've been managed. You're not buying those cattle without knowing much about them. Transportation costs, commission, all those you're going to pay regardless. So the most profitable group of cattle that you can background or stocker is oftentimes the ones that you produce yourself. So think about adding value in traditional ways like that. And then beyond that, if you're large enough and can do so, look at things like marketing arrangements. Look at things like value add opportunities. Freezer beef is something that a lot of folks, even that are fairly large, have found, I can add some value by moving some freezer beef, right? And you don't have to be small to make money with freezer beef. In fact, a lot of our larger producers have found that they'll take some of the cattle that just simply don't fit as well. Meaning I've got some smaller frame cattle, I've got some off-color cattle that won't go well on a load, or I'll get really discounted in terms of, price by selling those cattle. I'll just feed them and sell freezer beef. And, you can take what would have been a discount, right, and make it into premium. So look at things like that you can do to add more value. And there's oftentimes those things out there. We're in an environment that's tough, right? It's just tough. It's not an easy business, but there typically are ways to increase revenues.
All right, this next one, it comes from our Q&A box. Is packer leverage increasing? And in your opinion, how does it shift back to the producer?
Yeah, it's a good question, and hot topic as well. I've never discounted this at all. I mean, you can't argue that there's not a fair amount of market power, given the structure of the packing industry, right? You've got some packers that have a lot of market share. So there is some leverage associated with that. There's no question about it. On the same note, though, the work that's been done is less clear about how much that affects price, right? Concentration really hasn't changed that much since 2014 and 15, right? When we saw a very different cattle price environment. So I think part of the answer to the question is, that balance of power, if you will, really comes back to, I think, partly cattle numbers, right? And the fact that the cow herd is getting smaller, and it looks like we're going to have smaller calf crops, that does shift some leverage back. And it's like a broken record, I apologize, but you've also got to be selling the type of cattle that are marketable, right? And that's what people want. And that's another way that you kind of shift some of the power. You've got to have groups, you've got to have cattle that either can stay together and do well, or that can be marketed in groups that can stay together and do well.
I've got one last one, but guys, the chat line is open if you all have any more questions. This one, I definitely think we could have a whole nother webinar on, but we did get a lot of how to use futures, give me futures and option info. You can give a little bit of an overview, but where can they find some more information, or, where do you go?
Yeah, absolutely. So really good question. There are some good resources out there. I've got a couple publications that I've done over the past few years. One is based on just simple futures and option strategies. So straight hedge, using an option. I've also got one on advanced strategies, and those are good. But there's others from other states too that I can certainly share with you all. I do have a video from several years ago that I could make available, but I will definitely say this. So for most producers in Kentucky that I interact with, that they tend to be smaller producers that really aren't large enough to use futures and options, and understand that for the information that futures provides us, anybody can utilize that, right? To use it for risk management, I've got to be moving 50,000 pounds of cattle or more. And that's a challenge for the vast majority of folks that I work with. So this livestock risk protection insurance product really is an attractive product. It's the first thing that we've really had available that was scalable to the sizes of cattle operations that we tend to have in Kentucky. So I would definitely encourage you to think about being on that April 20th webinar where we'll walk through that. That'll be recorded too, by the way. And certainly reach out to me in addition for futures and options stuff. I'd be glad to do another short video series on futures and options. The one I've got now probably was done back in 15 or 16. So I do a fair amount of those programs. I just haven't done a live one in a while, obviously. So.
Well, I do know that it was mentioned a lot, so we might look into that.
So Kenny, the next question is, I'm seeing farms selling off each week, going in subdivisions and not back in farming. Does this trend attribute to the cattle numbers going down?
The short answer is yes. There's no question, the more farms that we lose, sure, the fewer cattle are out there. Do remember though, where we are in Kentucky, most of us are not that far from a fairly urban area. So don't mistake what you see around you for a national trend. For example, if you go back and look at census of agriculture, in 5-year blocks, the true loss in acreage is actually pretty small. And remember, just because a farm sells doesn't mean that the cattle are not in production somewhere, right? So I'm not discounting what you're saying at all. One of the challenges always is that, it's hard for cattle to compete with development, right? In terms of profitability, and that's going to be the case always. So it does impact cattle numbers, but also understand that, in Kentucky, we're about 3.5% of total U.S. beef cow numbers. So understand that, there's a whole lot of cattle out there in areas that they don't have quite the urban pressure that we do.
So along those same lines, how do you see that same trend with crop grounds? We've got high corn prices that are, expected to be really high this summer. And do you think that land will come back if they put it into crops, and will we get the pastures and the fences back for cows?
Yeah, we saw this a lot, and I guess I'm gonna have to stop and think. But I guess 2012 was our major drought year, and then we kind of had the ethanol boom, if you will, and we lost a lot of pasture ground to row crop. And can it come back? Yes, but I can tell you, it can go from pasture into row crop a whole lot easier than it can go from row crop back into pasture. And one of the questions I always like to ask is, are the fences still there, right? Because reestablishing forage is not easy, right? But in a lot of cases, when some of this pasture ground was converted to row crop, the fences honestly had quite a bit of age on them anyway. So it didn't seem like a major loss to pull those fences, you know what I'm saying? But then you start thinking about trying to replace that fence right now, and you've got a whole nother, it's a whole nother cost discussion. So the short answer to the question is yes, but we're going to have to see calf prices a lot higher than they are now to really pull some of that row crop ground back into forage. It's probably going to be a much, much slower process if we see it at all.
I'm not seeing any other questions. Are you back? Kenny, you did a great job then.
Thank you all for having me. I enjoyed it.
I just want to point out, just again on the risk management, I know you all are going to go over that. I do want to say that KCA's office is following this as well. We hope to roll out more education. I think that's step number one, definitely on the whole program. We are following it on a policy and legislation side as well. So just again, keep on the lookout for that. Please attend, Kenny and Josh's webinar to get more information, but you'll probably see some more of that info coming out of our office. Anything else you want to say, Kenny?
No, I always like to leave groups by saying I wish you good weather and good prices, and I sincerely do.
Absolutely. Well, thank you. Thanks, Beck. And
thank you all.
Thanks everybody for tuning in with us tonight. If you have any questions, feel free to contact us at the office. You can contact Kenny. He gave you his contact information. We did record tonight's session, so if you want to review some of the notes, or if you have somebody who wasn't able to tune in, they can always check it out on our KBN YouTube page. All right, thanks everybody. Have a good night.
Thank you.